Just to take a really simple example, let's say that there was, the bar of gold in front of us, and I wanted to sell it to you, and you wanted to buy it. We would go back and forth over the price. We'd agree on a price, and we'd sell that bar. But what if we had one bar of gold, and just make up, let's say a 1 ounce gold coin, so $1,400. And I said, okay, Lynette, I could sell you the 1 ounce gold coin for $1,400, but why don't I sell you 100 ounces? I only have 1 ounce sitting here, but we'll make the other 99 a paper contract. And we'll agree that either I pay you or you pay me, depending on where the price goes from here. So bear in mind, we only have 1 ounce of physical gold, but we do a deal on 100 ounces, 99 ounces of paper gold, and 1 ounce of physical gold. Well, that's a much bigger deal, a lot more money involved, a lot more profit and loss for either one of us. But there's still only 1 ounce of gold. The other 99 is the derivative. So a derivative is just a paper bet. It's a paper bet based on some underlying with no limit as to how big the paper bet can be. Now, I'll give you another concrete example. And I remember in 2007, when the mortgage crisis first hit in the spring, and then there was a money market crisis in August, and that's when Jim Cramer had his famous meltdown with Aaron Burnett on CNBC. They know nothing, but the point being, that was the beginning, and then it came to a head over a year later with Lehman Brothers in September 2018. But when it first started, there were some very smart people, and I would put, Ben Stein and others. He's an economist, and he's a comedian, actor, but also an economist. And a lot of other people said, look, there are $1 trillion of subprime mortgages, and that's about what there was with Alt-A. That's another kind of subprime, but let's say $1 trillion of subprime mortgages. In the mortgage market, 5% is a huge default rate. When default rates get to 5%, people are kind of panicking. He said, let's get crazy. Let's assume a 20% default rate. It never got that high, but just assume it. Well, 20% of 1 trillion is 200 billion. So he said, even if this thing gets totally out of control, we'll have 200 billion in losses, which was about the same in real terms as the S&L crisis in the 1980s. That was about 135 billion of losses. So adjusted for inflation, it would be $200 billion by 2007. And Stein said, well, we survived the 1980s. We can survive this. It's about the same. What he was missing was that, there were $1 trillion of mortgages, but there were $6 trillion of derivatives on the mortgages, on the same mortgages. And so 20% default rate, it wasn't 200 billion, it was 1.2 trillion of losses just to get started. And then the panic went on from there, and the losses were ultimately in the scores of trillions.
Right.
But the point being, you cannot look at bank balance sheets. You cannot look at futures contracts. You cannot look at any known quantity and understand the risk without understanding how much is off balance sheet, how much more of the same thing, the same kind of bet. And banks do not put derivatives on their balance sheet. And I've had this debate in chapter 8 of the book, chapter 8 of Aftermath. I talk about a private briefing that I had with the board of directors of Morgan Stanley and their CEO, James Gorman. And I said, well, first of all, a couple things. Number one, your derivative book might be smaller, it actually was, but that's because so many of the derivatives were moved over to the clearinghouses. They created these clearinghouses after 2008. So now, two banks do a derivative trade, and they take it and they send it to the clearinghouse, and you put it on the balance sheet of the clearinghouse. You didn't make the risk go away. You just moved it to a side pocket. So maybe Morgan Stanley or Citibank's balance sheet has fewer derivatives, but it doesn't mean there are fewer derivatives in the system. They've just been put over in the clearinghouse. Who's going to guarantee the clearinghouse? Again, Morgan Stanley's capital base may be fine, at least in most circumstances, but who's backing up the clearinghouse? Well, the answer is the members, which are the banks. So if the clearinghouse gets in distress, they're going to turn to their members and say, hey, give us capital, at a time when the banks are like, oh, we can't do that because we need all the capital we can get. So first of all, you're undercounting derivatives when you ignore the clearinghouses, number one. Number two, and this was the point I made, I said, look, as a bank, you may be stronger, but you're part of a system, and the system is more vulnerable. And if the system goes down, you go down with it. I don't care how strong your balance sheet is. You're part of something bigger, and if that collapses, you collapse too. And I said, look, you're running a bank. You can't take responsibility for the whole world. that in theory is the responsibility of regulators and central bankers and others, but they don't know any more about risk than Wall Street does. I mean, everyone's ignoring the risks or not computing the risk properly. So I say, yeah, maybe your bank's more sound, but you're not counting the clearinghouse and you're ignoring systemic risk, which is bigger and more dangerous than ever. The warning signs are all over the place. You just have to understand them, incorporate them, connect the dots, and then see how it plays out. And it's not just one path or multiple paths, but they all sort of end up in the same place. And then I bring it full circle. I say, well, if this is coming, and it is, what are you waiting for? Why not get ready now? When I've had people say, I'll be half facetious, but it's kind of true. They say, Jim, I hear you, I agree with you, but I'm making too much money in the stock market. Could you call me at 3:00 the day before the crash, and I'll sell my stocks and buy some gold? And I said, well, first of all, I'm not going to know the day. I can tell you it's coming, but I don't know the day. And I might, if I did, I'd probably be a little busy myself. But the point is, when you most want your gold, when the panic hits and everyone like, get me out of stocks, get me out of money market funds, I want gold, you're actually not going to be able to get it. You're not going to be able to get the gold. The dealers won't talk to you if they don't already know you. The mint will be back ordered. The dealers will be back ordered. You will not be able to get people on the phone. So why wait for that? Do it now while you can.
Right. It is, because there's, you were talking earlier about people selling their stocks and their money markets and all of these and buying gold before the crisis hits. But will there be any buyers on the other side of any of these assets?
Well, that's right. And this is what I talk. Well, that's correct. Now, this is what I talk about in chapter 4 of the book, how more and more assets under management have moved to passive investment styles.
Yes.
That means index funds and ETFs and things like that. Well, when passive investing started, when it began, I analogize it to like a mosquito lands on the back of an elephant. Well, the mosquito has a good time and the elephant doesn't even notice. So passive index funds were basically piggybacking on active investors who were committing capital, taking risk, and making markets, engaging in price discovery, and you could just kind of go along for the ride. But what happens when it's not one mosquito, it's a billion mosquitoes? The answer is the elephant dies. And that's what's happening in markets. More and more funds are going passive, fewer and fewer are going active. Well, the active investors are the ones who commit capital and make markets. So you get into a financial panic with the passive investors. Their investors want their money back, so they have to sell stocks or sell assets or sell bonds to get money to pay the redemptions. Well, where are the buyers? Yeah, you've driven the active managers out of business. They're not going to be heroes like firemen rushing to a fire. They're going to walk away, and so the market's going to go no bid, and it's going to go straight down. The Fed, is at the height of the pandemic panic, going back to 2020, the Fed's balance sheet was up to about $9 trillion. I had to get used to saying trillion instead of billion, but about $9 trillion. And it's come down a little bit since then, but people say, well, wait a second, how can there be a dollar shortage or a liquidity crisis when the Fed printed $9 trillion? Well, the answer is you have to understand how the money system works and where real money creation comes from, and it does not come from the Fed. And here's why. The Fed did print the money, that's real. But the way they do it, the Fed buys bonds and treasury notes from the primary dealers, from the big banks. And they call up and offer me a 10-year note. Okay, here's the price done. Goldman Sachs will send the 10-year note to the Fed, and the Fed pays for it with money that comes out of thin air. So that is money printing. It's as simple as that. But then Goldman Sachs, in my example, takes the money and gives it back to the Fed, because the Fed's a bank. They deposit it at the Fed in the form of what they call excess reserves, and the Fed pays interest on excess reserves, so the Goldman's actually making money off it. The point is the money didn't go anywhere. The Fed did create it out of thin air, that much is true, but the recipient who sold the bonds gives it back to the Fed. It sits on the Fed's balance sheet. So the asset side, you've got all these treasury notes, but the liability side, you've got all these deposits, and it just sits there and it doesn't do anything. So where's the real money that powers the economy? If there is, if it does at all, where does that come from? It comes from the banks, because the banks can do the same thing. When the bank makes you a loan, what do? You're a business, you set up a checking account. They say, okay, here's $1 million loan. They put the $1 million in your checking account. Where'd that money come from? They just said you got the money, right? And so they have an asset, which is a loan from you with note, and they got a liability, which is your deposit. So banks create money kind of the same way the Fed does, except it's supposed to be in private commerce. And that money actually can go somewhere. If you're a business, you got to payroll, you got to buy stuff or invest stuff, et cetera. But there's not much of that going on. Velocity is very low. The turnover of money is low. But the point is that hasn't really been going anywhere. Now, but here's the key. $9 trillion on the balance sheet, maybe, 5-6 trillion today. It's a lot of money. But the notional value of derivatives off balance sheet of the banks is $1 quadrillion. And for listeners who might not have heard the word quadrillion before, 1 quadrillion is 1,000 trillion. So your 9 trillion at the Fed doesn't get you very far if you have to support 1,000 trillion dollars worth of derivatives. And how does that work? Well, the answer is mostly the banks doing off-balance sheet swaps and swaptions and other futures and forwards, and we don't have to go down the whole litany of names, with either each other, because they're trading firms, or with hedge funds who want them for speculation or hedging, or sovereign wealth funds or other institutions. There's a whole network of participants. But these are the big boys. These are the $1 trillion institutions, the BlackRock and the Temasek and the Sovereign Wealth Fund of Norway. These are the big players involved in this market. Okay, so you have $1,000 trillion of derivatives off balance sheet. By the way, you will not see this looking at a bank balance sheet. You got to read the footnotes. You got to know what you're looking at. How is that supported? Well, it's supported with collateral. Not 100%, not even close, but maybe 1%, 2%. You got to put up some margin money to be in the game, but then you can have a lot more off balance sheet. Okay, so what's the best form of collateral? Well, it depends. Whether you're in a liquidity crisis or not, whether people are feeling confident or are worried, whether they think things are going to go great or start to collapse. So as things get more difficult, and that's the phase we're in right now, the quality of the collateral has to go up. So the banks are now saying to each other, I don't want your mortgages. I don't want your stupid corporate bonds. I don't even want 10-year treasury notes. Get me bills, treasury bills. These are short-term, very liquid, 1-year maturity or less. A lot of them are 4-week bills, 8-week bills, 6-month bills. These are very short-term, very liquid. They are the best collateral there is. And the banks are saying to each other, that's what I want. Okay, so now you're Barclays Bank or Deutsche Bank or Unicredit, Credit Suisse or bank, some major Japanese bank, et cetera. Where are you going to get the bills? Well, you got to buy them from a dealer, or you can buy them at auction. The Treasury has auctions, or you can get them from the Fed. But to buy a dollar-denominated Treasury bill, you need dollars. So that's why the dollar is so strong. Everyone's like, hey, Jim, we got these huge budget deficits and $1 trillion of expenses and bailouts and handouts and, 131% debt to GDP ratio, $31 trillion in debt, et cetera. How can the dollar be so strong? Well, the answer is it has nothing to do with everything I just said. The dollar is strong because everybody in the world needs dollars to buy treasury bills, to prop up the balance sheets of the 1 quadrillion of derivatives that nobody can see. And this is real. This is way behind the curtain, Ken. This is real inside baseball in terms of how the international monetary system actually works. So the strength of the dollar, which, by the way, is a headwind for gold, the euro's down, sterling's down, the Swiss francs are down. Gold hasn't actually gone down a lot. It hasn't gone up a lot, but it's holding its own. But a strong dollar means anything denominated in dollars is going to go down, because if the dollar gets stronger, the dollar price of the commodity gets lower, or at least doesn't go up a lot. Okay, so first of all, you got a mad scramble for dollars. Why? To buy treasury bills. Why? Because they're the only collateral to prop up everything I just described. Now, but there's evidence of this, and again, you have to know where to look. So right now, the Fed has what they call the reverse repo program. What is that? Well, any bank, any major institution that wants treasury bills can call the Fed and say, give me some treasury bills. And you give the Fed cash. It can be overnight or a couple of days or whatever. The Fed pays you interest, so you're making a little money. Then they send you the treasury bills. Well, why isn't that the solution? Why doesn't that work? Well, the answer is you can do that, and you can get those treasury bills, but you cannot rehypothecate them. You cannot pledge them to anybody else. You have to keep them. And the Fed might want to unwind that at any time. Well, that's not good enough, because if I'm supporting some other transaction with somebody else and they're supporting another transaction through a chain of could be 25 banks all in the same, back to back, I want treasury bills that I can pledge to Credit Suisse, so they can pledge to Barclays, so they can pledge to JP Morgan, et cetera. So I got to get treasury bills either at auction from the treasury, and they're not issuing that many because actually the budget deficit is coming down a little bit, or buy them in the secondary market. Just to put some data behind this, Robert, just to show it's not a theory. So I can, if I'm a bank, I can call up the Fed and get treasury bills, in 15 minutes, and there's a certain price. They're going to pay me interest. I'm going to get a discount and give it back. If I buy it in the treasury market, there's also a price. I got to, they always trade, they mature at par. So you buy them at a discount, and the difference is how much interest you make. Okay. The interest, the yield to maturity on the treasury bill that you buy in the secondary market is lower than what the Fed will give you for free just by picking up the phone. So why would you ever buy a treasury bill in the secondary market with a lower yield than what the Fed will hand you? Well, the answer is because you can rehypothecate it. You're desperate. You're willing to take less yield to get the one that you can pledge, instead of getting a higher yield for the one you can't pledge. So it's all about the rehypothecation. But the point being, the fact that yields on secondary market purchases are lower than what the Fed will give you for free tells you how desperate people are to get those bills.
So that's causing us a liquidity crisis.
That's the beginning of a liquidity crisis.
And that's what you're warning everybody about right now.
Right.
I mean, you want a lot of things.
I spoke to someone recently. I said, well, Jim, I hear you. When's all this coming to a head? And I said, maybe this winter or this spring, sooner than you think. And I based that on the last two super liquidity crises, when the world almost completely collapsed, or maybe it did, were 1998, that was long-term capital management Russia, and 2008 during Lehman Brothers. But I remind people, Sunday, September 15, 2008, Lehman Brothers filed for bankruptcy electronically on a Sunday night. And that was like, we all know what happened next. But that crisis started in 2007. Remember August 9th, 2007, Jim Cramer and Aaron Burnett on CNBC, and he's yelling, they know nothing. They know. Well, he was right. They didn't know anything. They were idiots, meaning the Fed. But then Hank Paulson and the Super Civ and the sovereign wealth fund bailout, and then Bear Stearns, Fannie Mae, Freddie Mac, and so there was a lot leading up to the Lehman Brothers, but it took a year. It took a year to go around. Same thing with long-term capital. It came to a head in September 1998. We were hours away from shutting every financial market in the world. We got the $4 billion in, stabilized the balance sheet, and life went on. But it was a really close call. But that started in June 1997, when Thailand broke the peg to the dollar, started to run on the bank in Thailand. It spread to Malaysia, Indonesia, South Korea. You always hear the expression, time to buy is when there's blood in the streets. Well, sadly, there was blood in the streets, real blood in Korea, because people got killed. And then it went to Russia, then long-term capital. But my point is, everyone knows the acute stage, September 98 or September 2008, but it began a year earlier. So now everything we've just been talking about is already happening. It's been happening since last spring. So if you stick to this 1 year rule, and it's not a hard and fast scientific rule, but we've seen two cases where it took a year to come around. If that's your rule, and it started in March 2022, and there's good evidence for that, then kind of March 2023 is your D-Day. The debt's not going up at 2% or 3%. The debt's going up 8, 9, 10% or more. The U.S. had a $1 trillion baseline budget deficit, $1 trillion per year deficit for fiscal 2020 pre-pandemic. The Congress threw $3 trillion of emergency aid on top of that. And I'm not even criticizing all those programs. I mean, the payroll protection plan loans, the extended unemployment benefits, the increased unemployment benefits. Imagine where we'd be if we hadn't done that. But that aside, debt is debt. They piled $3 trillion on top. Now, this is going to take the U.S. debt to GDP ratio up to 135%. It was 106% when Donald Trump was sworn in. It's close to 130% today. Because remember, you got two things going on. It's a debt to GDP. So debt's your numerator and GDP is your denominator, right? Well, what happened? Well, the denominator shrank. This got smaller and this got bigger. So what happens to the ratio? It blows up. So now it's 135%. If you get the laws of economics right, which is not easy because most economists don't,
Yeah.
but if you get them right, it's really a reflection of human nature. I mean, what is an economy other than all the people in the economy starting businesses, buying, selling, traveling, providing goods and services, etc. So human nature doesn't change, or at least it hasn't changed much in the last 100,000 years. So the fundamental laws of economics don't change either, but circumstances change, facts change, and that's important. Now, to answer your question, Curry, you're right. There is a school of thought, a growing one, an influential one, that the debt doesn't matter. It's like, well, wait a second. So what? So the debt to GDP ratio went to 135%, which it did. Who cares? Well, what's wrong with it? 180%. We got issues. We got problems. Print up the money and monetize the debt and spend it and keep going. What is the problem? This comes under the banner of something called modern monetary theory, MMT. It's flawed, it's wrong, but it's got its followers, and those followers are now in the White House because one of the things Joe Biden had to do to get elected was to make peace with the Bernie Sanders wing of the Democratic Party. They take the view that if the Treasury didn't spend the money, how would anybody make any money? That's ridiculous, but that's what they say. They say, hey, when the Treasury spends money, what do? Well, they build aircraft. They have benefit programs. They have government contracts. They do whatever they do. But when the Treasury gives you the money, you take the money and you spend it on somebody else, goods and services, go out to dinner, have subcontractors, whatever it might be. That's the real source of money. They also take the Treasury and the Fed and they merge them. Now, that's not legally the case. The Treasury and the Fed are separate institutions. The Treasury is just part of the executive branch, and the Fed is an independent agency. And the Federal Reserve banks are actually privately owned. That a lot of people know. Some people know that, some people don't. But the Federal Reserve banks are privately owned by banks in the districts, or Citibank, Bank of America, et cetera. So they're completely separate. But the theorists ignore that and say no. The Treasury needs to spend money because that's how the economy grows, and the Fed can monetize the debt. So you spend the money you don't have, you borrow to cover it, you issue bonds to cover the borrowing, and if the market wants to buy the bonds, fine. But if not, the Fed can buy them and put them away on the balance sheet, wait 30 years and collect the money. What's the problem? Who cares about the debt to GDP ratio? It's kind of a statistical abstract, but why should that stand in the way of using money to solve our problems, which are free healthcare, free childcare, free tuition, forgiveness of student loans? That's a 1.6 trillion dollar ticket, by the way. And look, everyday readers and investors, there's no reason they should know all this stuff. This is total inside baseball. You have to be a geek like me to kind of keep up with it, but it's all coming. But what that means is we're going to test the Rogoff-Reinhardt thesis. Now, let me just take a minute to explain that. Up to a certain debt to GDP ratio, there is a Keynesian multiplier greater than 1. So the classic example is the UK was in a depression before the rest of the world. They had been hit pretty hard before the Wall Street crash. People aren't spending, they're saving. It's the liquidity trap. So if you get money, you pay down debt. When you don't have any debt, you put it in the bank. Whatever you do, you don't spend it. You hoard cash. Or people were buying gold. They were accused of hoarding gold, etc. But what they weren't doing was spending. And there was a lack of aggregate demand, and the banks were not lending. So Keynes said, well, if everyday people won't do it, the government must. The government can borrow. The government can spend. And what they discovered was that if you borrow $1 and spend $1, you can get $1.50 of GDP. Now, there's a separate debate as to whether that's actually incremental or whether you're just pulling growth forward. But so what? Even if you are pulling growth forward, maybe that's what you need to do when you're in a liquidity trap. But there's a problem. He called it the general theory of employment, interest, and money. But it was actually a special theory. I think he had a little Einstein in me because of the general theory of relativity. But it's actually a special theory, which means it's a theory that works in a set of circumstances, a set of conditions. The conditions where it works are you're either in a recession or just coming out of one. you have excess capacity and labor and industrial capacity, and you have very little debt. In those circumstances, you can borrow a dollar, spend a dollar, and get more than a dollar GDP. The problem is that extra GDP you get for the borrow and spend, it goes down as the debt to GDP ratio goes up. What Reinhardt and Rogoff discovered is that at 90%, you go through the looking glass. Your payoff is now less than a dollar. You borrow a dollar, you spend a dollar, and you only get 90 cents of GDP or 95 cents, etc. So now, not only are you not getting your dollar's worth for the borrowed dollar or something more, which you did at lower levels, you're getting less than a dollar. So now what's happening? You're borrowing a dollar, you're spending a dollar, you're not getting a dollar of GDP, but you are getting a dollar of debt, which means your debt to GDP ratio is going up and the 90% is getting worse. And I just mentioned the United States is at 135%. So here are your two competing schools. There's the Keynesian multiplier and creating aggregate demand with government debt, and the Reinhardt-Rogoff, more than a thesis, I would say powerful evidence that beyond 90%, it doesn't work. It goes under less than one, on the one hand. And my friend Stephanie Kelton and Bernie Sanders and Kamala Harris and the modern monetary theorists who say, no, it's all good. How could you get growth if you didn't spend money through the government? These theories don't agree at all. We're going to find out which ones work. I'll give away the answer, which is that Reinhardt and Rogoff have it right. Keynes had it right up to a point. Reinhardt and Rogoff discovered that critical threshold, that whether you want to call it tipping point or phase transition, or which physicists call it or whatever. The modern monetary theorists think the opposite, and we're going to find out. But what it means if Reinhardt and Rogoff are right, and I'm right, and Keynes was right, the more you borrow, it's actually a headwind to growth. Now you get just as up to the threshold, you got more and more and more. Oh, sorry, at a low level, you got more, but then it went down. But it's like any diminishing marginal return. You know, the curve starts very steeply, you get a lot of payoff, then it flattens out, then it goes down, but it's still positive. But at some point, it goes below the zero line and your marginal return is negative. And that's where we are. There were $1 trillion of subprime mortgages. These are mortgages that, no documentation, don't have to prove your income, very non-credit worthy. But there was a bubble mentality, a frenzy, and everyone, hey, buy a house and borrow money, fix it up, sell it for twice as much, walk away rich, and everybody was doing it. Mortgage default rates rarely get above 5%. 5% is really high in the mortgage market. So people were saying, smart people like Ben Stein, the financial analyst, but the central bank and others were like, well, okay, let's get crazy. Let's assume a 20% default rate, which has never happened, but just assume that's true. On $1 trillion of subprime mortgages, a 20% default rate would be a $200 billion loss, which was only slightly higher than the S&L crisis of the 1980s. Adjusted for inflation, it would have been a comparable loss. And the attitude was, well, we survived the 80s, we'll survive this. Yeah, it's bad, banks will take losses, stock prices go down a little bit, but we'll survive. What they missed is, yes, there was $1 trillion of subprime mortgages, but there were $6 trillion of derivatives. Yeah. That was invisible. So all of a sudden, 20% of that was $1.2 trillion. So you create derivatives out of thin air. Yeah. And there's no limit on how many you can have. They're off balance sheet, meaning give me the balance sheet of the company, I won't see them. You have to read the footnotes and then the information behind the footnotes. So non-transparent, unregulated, no limit on size. So the crisis was actually much worse than anyone realized. And then when it started to collapse, the contagion spread throughout the financial system. My point about 2008, it was because we did not learn the lessons of 1998, and we flew right into 2008. But once again, we have not learned the lessons of 2008, and we're going to fly right into the next storm. In 1998, Wall Street got together and bailed out a hedge fund. In 2008, the central banks got together and bailed out Wall Street. Who's going to bail out the central banks? In other words, the point is each crisis is bigger than the one before. The intervention gets elevated, larger dollar amounts. And are we now at the point where there's no one left to bail us out? And one of the questions I'm asked most frequently is, okay, Jim, I kind of follow your analysis on how risk works and how complexity theory and capital markets, how that works. But where's the crisis coming from? What's going to be the catalyst? It's actually a long list. Now, student loans, there are $1.6 trillion worth of student loans.
So this will go, and kind of this gets to your point, Francis. How do capital markets and money markets and Fed policy kind of leach into debt and deficits? So when a lender, credit union, or anybody, or university makes a loan to a student, and the Treasury guarantees that loan, which they do, it's off budget. Again, it's not strictly a derivative, but it is non-transparent. So then the student defaults, and the credit union, the lender, simply turns to the Treasury and said, "Here's your loan file, pay me," and the Treasury pays the lender because they've guaranteed the loan. Now it's on the Treasury, but until that point, that loss is not on the books of the United States government. That loss is not part of the deficit. But when the Treasury writes the check to make good on the guarantee, it does go into the deficit. So we think deficits are high now, but there's this $1 trillion tsunami of student loan losses that's going to pile on top of the structural deficits and make it even worse. So all these things are, I spend all my time analyzing these things. I see them all. I can describe them. I can see how they're going to converge into a worse crisis. But in the short run, people either ignore them or they just don't know anything about them. But why would Bernie Sanders even suggest that? By the way, he's not alone. I think the other candidates of, Elizabeth Warren and Joe Biden and Kamala Harris, one way or another, have suggested that they would do something similar, that we need student loan relief, and that ends up going onto the budget and onto the taxpayers. But there's a school of economics, and I talked about this in Chapter 5 of my book. It's called Modern Monetary Theory, MMT for short. Everyday viewers, everyday people to know anything about it, but more to the point, economists don't know anything about it. This is a new school of economics, if you want to think of it that way. So there is this modern monetary theory, but the leading scholar of modern monetary theory is a lady named Stephanie Kelton, who's a professor at the State University of New York. But she's the financial advisor to Bernie Sanders. What modern monetary theory says is that actually there's no limit on the amount you can spend. You can spend as much as you want, and the market will either buy the debt, or if they balk, the Fed will monetize the debt. So how much debt is there relative to the size of the economy? This is called the debt to GDP ratio, but the way it's a simple fraction you learn in the 5th grade. How much debt divided by the size of the economy? So in a simple example, if you had $5 trillion of debt and a $10 trillion economy, that fraction would be 1/2. So you would say the debt to GDP ratio is 1/2 or 50%. Today, the debt is larger than the economy. That ratio is over 100%. We have round numbers, about $23 trillion of debt and about a $22 trillion economy. So the ratio is about 105%, highest since World War II. That troubles me, it troubles other economists. But my friend Stephanie says, what's the problem? You could take it to 150%, 200%. 250%. By the way, that's where Japan is. Japan's at 250%. Greece is 175% or so. Italy's 135%. They're all still standing. And go to the Ginza, it looks like Times Square. So you don't see visible signs of stress. And here's the irony. Ben Bernanke would absolutely not agree with this theory, and he said so publicly. But Professor Kelton says to Bernanke, you proved our point. You were the one who took the Fed's balance sheet and quadrupled it from 800 billion to 4.5 trillion or so. You proved that you can print trillions of dollars of money without causing inflation, without causing high interest rates, without causing a run on the bank. So all we're saying is, you did it to prop up Jamie Dimon's bonus. We wanted to do it to forgive student loans. We may have different policy objectives, but the process is the same. What's the problem? Now, of all the things I've debated for years, I was dragged into Bitcoin versus gold debates, which I thought were silly. I mean, I don't like Bitcoin. I do like gold, but it's like fish versus bicycles. I mean, the debate never made sense to me, even though I did a lot of them. Of all the things I've had to rebut, this was actually the most difficult because it's superficially appealing. First of all, legally, it is true that the Fed can take their balance sheet as high as they want. There's no legal limit on the Fed's ability to print money. It is true that Japan has a much higher debt to GDP ratio, and they're still standing. It is true that the Treasury can borrow as much as they want, subject to periodic increases in the debt ceiling, which have never been denied. And the Fed can monetize the debt. So all the elements of the thesis are actually correct. So how do you refute it? And the answer is that legally it can be done. And if your goal is to print a lot of money and forgive student loans or give a guaranteed job or guaranteed basic income, whatever it is, in theory you could do that. But there is an invisible psychological boundary, and this is what the modern monetary theorists don't understand, and I don't think Ben Bernanke understands it. There comes a time when people wake up and they say, I don't know what's going on here. I don't have a PhD, but get me out of the dollar. It doesn't. And so, I'll buy gold. I'll buy silver, land, oil, natural resources. I'll buy a new car, buy a house. Get me out of the dollar into something tangible, because I no longer trust the monetary authorities. I no longer trust the Congress. I can't believe that you're going to spend this much money without ceiling, without limit, without causing inflation. My inflationary expectations will go up. And the way to deal with that is to buy hard assets, starting with gold, but not exclusively gold. There, as I say, land, real estate, natural resources. They're all good. They're all good substitutes. At that point, interest rates will skyrocket. All of a sudden, the bond market will have difficulty selling it. The president of the Congress could take away some of the Fed's independence. All these assumptions could come crashing down very quickly, very unexpectedly, and that's the problem with the theory.
We're seeing something globally we've never seen before, and it is the best single indicator of a recession. The last time we saw anything like this was 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying no. This is bad, and it's going to get worse, and it's actually too late for the Fed to do anything about it. But what happens is, as you get closer to the actual thing you're worried about, the inversion gets nearer and nearer. Now it is literally a month away or less. So that's like a big red siren, a flashing light, whatever you want to call it. Interest rates are a lagging indicator. Everyone's like, well, how could interest rates going up if we're in a recession? The answer is, as you get close to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. Inventories are sky high and new orders are being slashed. You're not moving anything by truck. A lot of business people are living in the real world in real time. They know what's happening now, and the stock market tends to figure it out later. But as far as banking and credit is concerned, what happens is if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. If I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I don't want material adverse average change clauses kicking in. Instead, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards. They stop doing loans. And then interest rates will start to come down. But interest rates peak after the recession has already begun. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. What I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. They're going to keep going for the reasons I explained. That means they're going to make it worse. They're going to make the recession even worse. And they may pivot to say that there could be a rate cut. It won't be in April, but rate cut in August, maybe. I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. They over-tightened. They didn't look at the forward indicators I described, and they found out too late. Then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes. and then pivot. And we've seen this movie before. This is exactly what happened in 2018. I mean, I don't know. Attention spans seem to be short these days, but it wasn't that long ago. Go back and look at a chart, any stock index chart from October 1st, 2018 to December 24th, 2018. Less than 3 months. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? It dropped 20%, culminating in the Christmas Eve massacre, December 24th, 2018, when it dropped, I think NASDAQ dropped like 3% in one day. Now, here's the point. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre, and after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market. This whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets, and that's the key word. It's not if stocks are going down, but it's kind of a little, 0.5% a day, 1% a day, trending down, lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic. It dropped like 30% in like 2 or 3 weeks. The fall of 2008, I mean, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly, but not just because they're going down. So there may be a pivot, in late August, or July thereabouts, but not because of Goldilocks, but because it's not a soft landing, it's a crash landing.
But real quick, I guess, let's stick on the recession just for 1 second, because there's the, bad recessions generally come along with a lot of job losses. Do you see, given that this recession could be worse than most are expecting right now, there being, wide-scale layoffs of the sort we've seen in some of the bad previous recessions like '08, like '01?
The answer is yes. First of all, we're seeing it already. So, I don't match the company to the exact number, but layoffs on order of magnitude 10,000 to 20,000 terminated employees at Google, Amazon, Facebook, and other tech names. It affects other sectors as well, but tech in particular has engaged in a massive series of layoffs. And so people go, well, wait a second, how come it hasn't shown up in the unemployment numbers? Because the unemployment rate is it's around 3.5, 3.6, I don't know the exact number. It's right in that neighborhood, 3.5, 3.6. We haven't seen that level of unemployment, that low, that is, since the 1960s. This isn't like, a good year or a good day. This is the lowest since the 1960s. And the Fed is absolutely looking at that. You're right about that, Adam. And they're saying, and of course, they believe in the Phillips curve, which is junk science. But the Phillips curve, for those who are not familiar, says there's an inverse relationship between unemployment and inflation. So if unemployment is high, inflation is low. And if unemployment comes down, inflation goes up. And so if you want to get inflation down, you should expect to bring unemployment up. That's what the Fed believes. What I just said is nonsense. It's not true. It's junk. But the Fed believes it. Again, it doesn't matter what I think. It matters what the Fed thinks. They say you got to put yourself in their minds to figure it out. So as far as they're concerned, those kind of unemployment numbers, lowest since the 1960s, that's inflationary. They got to get those numbers up. Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer, entrepreneur, and you're in any kind of distress, not as many customers walking in the door, you'll do everything you can to avoid laying people off. You'll, be late on the rent. You'll turn down the lights. Find a cheaper laundry, whatever it takes. And then by the time you get around to firing people, you run out of options. Like, I've done everything I can. Now my business is in jeopardy. I have to fire some people. So that, and then combine that with what I just said about severance and, rolling terminations, et cetera. It's a lagging indicator. We know enough right now to know that number's going up this spring. But that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect, that unemployment's a lagging indicator. Now, having said that, what else is the Fed missing? Well, wages are up 5% on an annualized basis, 5.2% on an annualized basis. I'm like, yeah, and inflation's 7% or 6%, so your real wage just went down 1 or 2 points. Because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake, but you have to know that they're nominal, and you have to subtract inflation to find out what's happening to real wages. And the answer is real wages have been going down for a couple of years because they runs around 5% annualized, give or take. Sounds like a 5% raise. What do you want? Well, yeah, but with 8-9% inflation, or even 6% inflation, your real wage is going down. So that's not a robust number at all. The Fed, by the way, the Fed wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it. If you get inflation down and wages are constant, then the real wage goes up relative to where it was before. But if you're unemployed, you have no wage. So that's another issue. Now, what the Fed is missing, and it's a long list, but there's something called the labor force participation rate. Now, the labor force participation rate, you just take the number of people working divided by the total working age population. It's all you do. It's not sophisticated. And that number today is around 61%, 61.2, give or take, percent. But as recently as 2000, that number was over 70%, and has come down ever since. And it dropped like a stone during 2020, during the pandemic lockdown. Came back a little bit, but not much. The reason it got, first of all, it's never 100%. It shouldn't be. There are legitimate reasons to be working age population not working. You're a homemaker. You're a student. You're an early retiree.
Right, you're in the military. Yeah.
You're in the, yeah, there's a bunch of perfectly good reasons. So it's never 100%, not even close. But 70 is pretty high and 60 is pretty low. And the trend has been down. So that leaves, relative to kind of a normalized number, that leaves about 8 to 10 million people between the ages of 25 and 54 who are not in the workforce. There's a big untapped labor pool. But if you took that group and threw it into the unemployment numbers, the way the Bureau of Labor Statistics calculates it, unemployment would be about 9%. And that's a depression level of unemployment.
Bima apain HP-nya nih Bima? Ini kenapa bisa loading terus di m-bankingnya? Kok nggak tahu Bima apain tadi malam ini? Nanti Mima apa nggak upgrade iOS gak?